Welcome to this episode of the Hotspot Business. Today we are going to look at accounting. We are going to look at how I arranged my accounts for the business and how I make decisions using these accounting numbers for the business. So let's get started. Now, for the purposes of this presentation, I'm going to look at an account reconciliation as at this date, 14th January 2026. Accounting is a very important aspect of any business, even for Hotspot, however small or big the business is. It is the one that is going to tell you if you're making money. It will tell you if you're breaking even. It will tell you, meaning you've reached the point where your costs and your expenses are equal, and you're starting to make profit. I mean, your income and your expenditures are equal, and then you're starting to make income. It will also show you what areas you need to improve or make strategic decisions on. So before you make these statements that you see down here, you need to collect the data. That's the first step. So data collection involves taking a note of all the activities that you do regarding the expenses, regarding the business, from purchasing things to investing, putting the money if there's any money you put into the business, all that must be noted. And it's noted in terms of date. You can see all the data here running from 21st March, 28th March 2025 all the way to January 2026. Yeah, all that. Now, these are different categories of accounts. This is the reference as for order, the date when the activity happened. This is the vendor that I purchased from. Then I arranged all these into different categories, account categories and subcategories, so that I could be able to raise these two statements, income statement and balance sheet. And these are the particulars for each and every transaction and their respective amounts. So data analysis is very good for accounting, and Excel is a very, very, very excellent tool for that. You need to know how to do pivot tables. Pivot tables are very good, and this is for example, now this is a breakdown of these accounting subcategories here. You can learn about pivot tables from very many videos on YouTube. We shall not go into that here. I'm just giving you the benefit, an appreciation of accounting and what it does for your business, even a Hotspot one. So these ones are so easy. You get a book, a ledger. You can get a simple book, or you can get a ledger with already drawn lines, and you draw these categories. You write these categories, reference date, vendor, subcategory, category, particulars, and amount. Do not miss any, because if you miss any, then you will not have correct data. So we start with the income statement. The income statement is the one which shows you your revenues and your expenditure, the money coming in and the money going out, and shows you if you're making a profit or a loss. There are different sections, but we're going to go through the sections one by one. So the first section here is revenue. So revenue is the income that you're getting. Where does it come from? And in this business is the sale of vouchers. We have different types of vouchers, this and that. Vouchers for 3 hours, 24, 7 day and 30 day. So according to my data, my sales data right here, this is the sales data. You can get this sales data from the reports in Micmon. If you want to know more about that video, please watch. If you want to know how to generate the report, watch the video right here. Just click and watch this. You'll know how to get the data for your sales. Then you feed back into this. So we're looking at the sales data. or income. So when you get that data, you can arrange it and you get all this summary from here. So I don't have device charging as a service, I don't have kiosk rental income, I don't have other income resellers, but the things that are going to come later. I expect to get a franchise, maybe I get someone, they run the business, we do revenue sharing, and then I'll put some income. Then income resellers, this one started, but after this reconciliation was done, so you're not going to see anything here, so it is 0. Maybe on the next accounting. Now the total revenue is all that you can see from the formula. All these are added and got here. Now the next thing you have to go to is the cost of sales. The cost of sales is the cost of doing business. If you want to do your hotspot business, what are those costs which if you don't incur, the business stops? Examples of direct costs, examples are direct costs and then equipment depreciation. In mind, those are the two I have. For indirect costs, you have things like let me give you one. ISP, paying for internet from the ISP. If you do not have that, then your business will stop working. Then I also put in depreciation. When you buy those routers and all that equipment, they depreciate with time. So you have to factor that in. Here's my depreciation calculation. It's here. So I have basically land and building, and land and building could be like poles, you know, any construction that I've done. I did some construction, social accounts to putting poles and all that. Then I have other assets, all the microtics, the routers, the cabling, the labor, all that goes there. And then these are the various appreciation percentages applied and to get this figure. And this 638 feeds in here. Where is it? Here. 6 to is this? That's very interesting. I have to look into that. This is it's a depreciation. Okay, let's see that. Let's see where that's coming from. Okay. It's supposed to come from here. So this is I have to correct that. Take that. Now you're seeing the correction live. It's here. Except now I have to minus this. Yeah? So that is depreciation. Can see. I see my depreciation. It's something I need to see. This is this. Oh, I have to do this. Depreciation has to go. Yeah. So that's it. Exactly. That's it. So after getting my total cost of sales, I have my revenue, net revenue. So net revenue, I'll get it by removing this total revenue and then from the cost of sales, and I'll get this 3,074,000. Yeah. So we earned this money. Then we removed the cost of sales. The cost of doing business came to this. And then on top of that, we subtracted. We got the net revenue. Yeah, you can see that where we subtracted the cost of sales from the total revenue. And then to get the gross profit, we get the net revenue and less the cost of sales. So we get 3,074,000. Now, operative expenses. Operating expenses are those things that you do in the business. Slightly different from this one, cost of sales. These ones you have to do as the business runs, to support the business for it to run. You have to pay wages or salaries. You have to pay rent. You have to pay. I had to pay legal fees for registering the business. Then movements, transport costs are here. Then repairs of anything that breaks. So that comes to about this 443. Yeah. And gross operating profit, rather operating profit, we have the gross profit, the other 3,070,000 for right here. This gross profit, we have to remove these operating expenses, these, right, to get our operating profit. Yeah, remember the gross profit was here. Now we have to remove operating expenses, the things which we have to spend on the business to operate, and we get this 2,631,000. Yeah? So interest income or other expenses and incomes would have gone here, but I don't have them, so they are not there. They are not here as a business. Maybe next time I may consider investing some of the money somewhere, maybe to create working capital, but I'll keep that there. Now, net profit before tax. So before tax, you have operating profit. This one here, it comes here. Then you net off these. Net off this. These other net of other income expenses I don't have, so it still stays the same, right? Then we apply tax. Tax is at 30%. So when you apply tax at 30%, let's see, tax chargeable is how much? No. See? So the tax chargeable is 30% of this, which means the tax chargeable is this. Is that? It's at 30%, yeah? It's at 30%. That's our total tax that we're going to pay. So the profit after tax, you get this net profit before the tax, which is this 2.631. Then you move the tax, and then you get your net profit here. This 1.8 million. So basically, that's how the income statement works. I had to make some corrections there on the depreciation, but that is it. You first make your total revenue, yeah, which you get from your sales. For vouchers, I showed you the sales data. Then you get your cost of sales. You remove from the total revenue. Yeah. Now after that, you calculate to get net revenue. That's the net revenue. Then you get the gross profit. You get the net revenue minus cost of sales, which we got here, to get the gross profit. Yeah. Now when you have a gross profit, you move on to operating expenses. You get your total operating expenses. Then you get the operating profit. So you get your gross profit minus the operating expenses. You get your operating profit right there. We are removing the expenses. Yeah, we have already got our incomes. We are removing expenses, and that's where we are. Then other incomes or expenses, if I had them, I would include them, but they are not there, so I don't need them. And then now we come to our net profit before tax. Well, you first have to get your operating profit, minus or add income plus income or expenses. Then you get your profit before tax. Application of tax, you get the tax chargeable, which is 30% of whichever percentage in your place, percentage of that of the net profit before tax, and you get your total tax here. Yeah. So we come to profit after tax, and you have to get your net profit and you remove this tax here. This is tax chargeable, then this total tax you pay, and then you get that. So according to these numbers, I'm still in profit. I've already made profit. The business has already gone past breaking even, and there's some profit entering the business. So when you're starting to make profit, you can decide, let me go on to buy more equipment, establish another point, maybe start reselling, which I did, and you continue like that. Yeah. Now the balance sheet. A balance sheet is basically a summary of what you owe versus what you own. So the total what you owe and what you own. Yeah, the two must be equal. Total assets is equal to total liabilities and equity. That's an accounting thing. So it's a rule. So current assets are what you own. You have cash. When you count your cash from the vouchers, you get there. In your bank account, if you have money that you've deposited, you put inventory. Inventory is the vouchers, and I calculated that here, right here. You see all these inventory stock. Your inventory is your stock, so you put it there, right here. That's the total. So that's total current assets. Current assets are those assets whose value you consider within a year, within an accounting year, a financial year. It is that. Now, non-current assets, they are those assets that or fixed assets. You consider them, they last more than after a year. That's their value. You have other assets here. This is where the routers fit, microtics, all that, access points. I go here. Land and buildings, this is where the poles go if you make poles or fixtures. Then the depreciation comes back again, and then you have the net fixed assets here. This plus this minus the depreciation, you get that. That's your total current, non-current assets. They're called non-current assets. So it is this plus this minus this, and then you get this. Yeah. So the net fixed assets, I removed. I added this plus this minus the depreciation to get this. Yeah. So we have our total assets at 14,168,228. Yeah, and that's okay. Now liabilities, I'm going to go a little bit summary on this. These are things you owe. Accounts payable, if you're supposed to pay one of your suppliers, maybe you bought a micro dick and you didn't pay within this time, you would have put it here. Yeah, you'd have to pay. Then the expenses, maybe which you have incurred but you have not paid, you put here. If you have borrowed, you put your loans here. I don't have any of that. Everything was bought cash. Long-term loans, you put them here. Total liabilities, I have no liabilities. Then owner's capital, this is all that I put. I have no retained earnings, and I have no net income for the period. So I have that. That's why they are equal. So 14 and then here 14. So that is my accounting. That cash flow statement, we are not going into that. I just wanted you to see. So basically on this, you get your transactions here, write them in a book, in a ledger, put them together, then you note, don't miss any. Then you come do a data analysis, pivot table. Then you get this data that you need to feed. These are all from pivot table. Depreciation, this one, no, this one was not. Yeah, it was from pivot table. Voucher stock data, cash recon, and all that. You can see all that. All these are pivot tables. Another option, if you don't want, you can get someone. If you cannot, or you prefer not to do this, you can hire someone to do the work for you and comes out with these figures. But the whole point is you need to know what is going on in your business. However small you think it is, or however big it is, you need to know what is going on in the business so that you're able to make decisions. One, maybe if you're making losses, maybe you cut costs or you re-strategize to get profit. If you like this video, like, share, subscribe, click the notification bell for more videos like this. We are going to discuss next time. We'll look at the different equipment that I've used, review of some, and see how you can, and the factors that you need to consider before you buy any single equipment for your hotspot business. Until next time, have a great day.